Hey, good afternoon, everyone. Marty Mazzora here, January 25th, 2025, with your end of week economic and markets update. Today, I can spend virtually no time on the economic update because there really isn't much to report. Of course, I could talk about a few of the indicators that came out, but what's important to us right here is how our PWA index scores, and for the second week in a row, it scores dead neutral, meaning equal odds of recession over the next several months versus continued expansion. And that's significantly better than the signal it's been sending for quite some time. And as I explained the other day on the video, therefore, at the margin at least, we have made some sector allocation changes, added to some places globally to reflect a somewhat better setup, but certainly not a setup where you let the pigeons loose and throw all caution to the wind, not by any stretch of the imagination. But it is incumbent upon us to respect the signals that we're getting and to appropriately, from a risk-reward standpoint, respond to those in the allocation of our core allocation or a core portfolio. So I thought for today what we do is explore the conditions, explore the dynamics that would allow the S&P 500 index as our proxy to go up another 10%, let's say over the next few months. What conditions? Again, what would be the factors that we think are likely to make that happen? And there, I think, are a couple of paths to getting there, and I kind of want to explore those. Now, to me, the most obvious path there would be a scenario that has the dollar getting yet weaker. Remember, right up in here, I said technically, it looked very compelling to us that the dollar was about to roll over, and that would be bullish, all things equal, for global equities, and indeed it was. I also said right up here that this was a very compelling technical look that yields, and this is the 10-year Treasury yield, we're about to roll over as well, and that would definitely be bullish for global equities. So a scenario where we get another 10% move from stocks over the next few months again would be one where we get continued decline in the dollar, right? And a continued decline in yields, as this bear flag pattern right here suggests is technically compelling. That pattern right there is a very classic looking bear flag. Folks have been doing these with me for years, know how these have not small probabilities of playing out, but they absolutely do not work every time. But that's clearly the pattern that we're looking at right here. If that were to happen, good news for stocks. So what would force yields lower? Well, the simplest scenario would be weak economic data and weak inflation data, or softer or tamer inflation data, over the weeks and months to come in the U.S. Sounds kind of interesting how a weaker economy would bode well for stocks, but a weaker economy would allow the Federal Reserve to start sounding dovish, start talking more rate cuts than is currently being discounted in the markets, and that at this juncture, even this late cycle spot that we're in, would short-term be bullish for equities. Where it gets bearish is when the data falls further into recession, and that would be unmitigatingly ugly for stocks, make no mistake, and very bullish for the dollar. Typically during recession, and I'm talking a global recession, money flows to the safest security on the planet, and that is the U.S. Treasuries, obviously denominated by the safest currency on the planet still. So that tends to be, at least as it gets going, a real boost, recessionary conditions are, for the US dollar. So there's a scenario where yields go a lot further down because the economy is rolling over and then the dollar begins to rise. Along the way, though, just somewhat weakening data, as I suggested, would see the dollar lower as well. Often what moves a currency is its interest rates relative to the rest of the world, and the dollar is the highest yielding currency, save for 2 or 3 other major currencies in the world, and therefore it's attractive. You can get a good yield relative to other places, so that's a boost for the dollar. Yields coming down, therefore would weaken the dollar outside of recessionary conditions. Okay, so that would allow some room for these exceedingly high valuations in the major U.S. averages, if you will, to expand because lower interest rates allow for higher, for example, price to earnings multiples. So that would be the ideal scenario, frankly. So what would get in the way of that? Well, initially, the tariff threats to become real. A big reason here lately why the dollar has rolled over is because the new administration is implying, at least for the moment, that they're not going to be nearly as aggressive, or don't want to be as aggressive as they were promising to be along the campaign trail. So that has provided some relief for the dollar, or you could say some strength for the currencies in the dollar basket. Another scenario, other than just interest rates, is that scenario that I keep talking about, where foreign equities, for example, are dramatically cheap relative to U.S. equities, in fact, historically cheap. So if we're not going to tariff all of our trading partners, or at least not aggressively or not at all, well, there's finally the green light for money to flow out of U.S. equities into cheaper global equities. And that has happened, as I intimated, of late, particularly to the Eurozone. In fact, I didn't pull up the chart for this presentation, but mutual fund managers have aggressively rotated the last month or so out of U.S. equities into European equities more than anywhere else. And that at large scale, of course, would be a selling of the U.S. dollar, would bring the dollar down and would bring the euro up. If we were to look at the euro, it'd be a mirror image of this because the euro is 60% of the U.S. dollar index, the DXY, which I'm featuring here. Okay, so that's the scenario, maybe the more positive scenario that would get us up. I'm just randomly saying 10% over the next few months. The other one would be the mild use or lack of use of new tariffs, coupled with serious stimulus right away, early in the administration. And that would come by way of further reduction in corporate taxes, a deregulation that tends to get CEOs and investors very bullish, and any other spending initiative that, of course, would run up deficits further, but the market doesn't seem to worry about that, at least not yet. That's a scenario where we would actually see yields rise on robustly good news, therefore less recession risk. It would also imply, at least initially, and I think that would be the case for the next few months, that the Fed would not yet start talking about rate hikes, not initially. But they certainly wouldn't be talking about rate cuts either in that environment. Now, the president last week said he wants the Fed to cut rates. Make no mistake, folks, that would not happen in a scenario where they're throwing stimulus in as well. The structural inflation foundation that we've now established in this economy would not be able to withstand that without inflation ramping up pretty good, in my view. And therefore interest rates even higher. But I think interest rates can go higher for a while in that scenario where we get that aggressive, growthy stimulus that the president was known for early in his first term. How much upside would be there? I don't think a lot more than this, quite frankly, because ultimately this would be valuations going further into the extreme territory. And like I keep saying, where they are now, historically, you really can't find a spot where ultimately they didn't resolve with a lot of pain. So we're already in that territory. It doesn't mean it happens tomorrow. Markets can stay irrational for a very long time, as it's been said multiple times over the last 100 plus years. That would probably be the scenario that would be your classic ultimate blow off top. And then we'd be looking at the second half of this year, having some severe problems in equities. And it would be at a minimum, that 30% decline in 2022 that was inspired by a run-up in inflation and a run-up in interest rates. And then, of course, if we did get a rapid decline in equities at a time when it's the largest percentage of household net worth that it's ever been, that would provide probably the reflexive impetus to bring on the next recession, and then it only gets worse from there. So I'm really giving you kind of a between a rock and a hard spot narrative, but let's not fully rule out the notion that in a scenario where it's simply slow but steady, no big new tariff regime, the economy is relatively staid and maybe drifts a little lower for a while, that would be a scenario where we get a nice move in equities and it would be more sustainable, but it's still going to be a precarious, somewhat of a high wire act even there. I think what I'm saying, folks, is ultimately odds are that this doesn't end well, but a really nice run up over the next few months in equities is not unlikely. And keep in mind that throughout the rest of the world, there's valuations that aren't where we are right here. So a portfolio like ours that's globally diversified could do exceptionally well in that environment. Okay, so while I'm on it, I'll just do the technical analysis here, and then I'll talk about a few other things and notes. So just working with the daily chart again, this takes us back to June of 2021. I wanted to show this because right now, and I'll zoom in here in a second, we are pretty much at all-time highs again in the S&P, as we were right here before that 30% fall off in 2022. And notice the bearish divergence that we had in the MACD, moving average convergence divergence, and in the RSI. Notice it now in both as well. Looks too familiar, right? We're coming out of a rising wedge pattern. We just kind of came out of that and fighting back in. It was a pretty good look right here. We lost the 50-day moving average and came back up. So just the chart by itself is not all that bearish to me if it can hold this breakout from Friday. Thing is, you notice here, it lost the 50-day moving average, came back, battled it before it lost it, and then it became pretty stiff resistance for several months before it bottomed. So we're looking at that now. And as you can see along the way, and again, longtime clients have been doing this with me, you know how reliable these indicators can be. Notice that when we were looking at it back in here, I pointed to a short-term bottom. The technicals were telling me to, and sure enough, we got a very nice pop. But then that rolled over very quickly. These bearish divergences actually held on, right? And then we really started forming a bottom right in here. Short-term bottom again, and then right in here, we were reporting we have a bullish divergence. This may be as bad as it gets in 2022. And sure enough, we came out of it. And along the way, you can see the technicals pretty much signaled when short-term sell-offs would occur. That was about a 10% decline in 2023. And you can see we were showing it looking like it was bottoming. Suffice to say, this is not a bottoming pattern right here, folks. So something to pay very close attention to. And I said I'd zoom in, just a one-year look so we can see closer what's going on here. So yeah, you can see right here we have just peaked our way back into all-time high territory with these very notable bearish divergences. As for the NASDAQ 100 index, also going back to mid-2021, you can see essentially the same pattern. You have your bearish divergence here. So again, it doesn't mean that we can't go bounding out of that. We've got big tech earnings coming out next week, and that could absolutely set the stage for that next big leg up that we were exploring here a few minutes ago. The dollar chart and the yield chart actually are suggesting, I think, good things. While the equity technicals don't look so great, The dollar looks like it lost its 50-day moving average on Friday. We follow through on that breakdown next week, and you can see when we finally break it, there's always these retests, but then you get these substantial moves typically. If we do, and the momentum says we could, then all things equal, that's very bullish for stocks. As for yields, I showed you this. If we get this bear flag pattern plays out and we end up with a 4.4% treasury yield, probably very bullish for stocks. So talk about a mixed picture, you got it. Equity charts themselves look suspect. These look very, very bearish for themselves, therefore very bullish for stocks. So going to be very interesting, to put it mildly, in the weeks and months and years, for that matter, to come. Speaking of mixed results, reading through multiple earnings announcements, I can pretty much split it down the middle. There are an equal number of bullish-sounding commentary from company reports in terms of what the economy looks like going forward, and bearish-sounding concerning commentary. So yesterday, after listening to BCA's morning discussion, I was compelled to pen the following. It's so interesting listening to the debate about the potential economic and market ramifications of additional or increased tariffs. In this morning's live chat, BCA, their equity strategists, U.S. equity strategists, argued that there really wasn't much pain felt amid what I'll call Trump trade war round one, and that the world really shouldn't be fretting over what may be coming. She was thoroughly corrected by their bank credit analysts by his citing how the manufacturing sentiment cratered upon implementation of tariffs, leading quickly to a recession in U.S. manufacturing, and S&P 500 member profits stopped rising. They didn't fall, but they stopped rising while nominal GDP continued to grow. He emphasized that what's presently being proposed is orders of magnitude worse than what was occurring during round one. My view is that the equity strategist suffers a bit of recency bias due to the so far resiliency of the current bull market in her space, U.S. equities. What I believe was entirely missing from the conversation and from both of them is that the policy response to COVID was so extreme that it effectively mitigated what might otherwise have been a substantially harsher recession. In fact, I'm certain of that. As the service sector would have followed manufacturing into the abyss, I'm certain that it would have, which is typically the sequence leading into recession. Now, this go round, we don't presently have such massive liquidity pending. There's not 11 trillion ready to come into the market, at least not at this point. In fact, as the economic impact of those pandemic savings ultimately fizzles, ramping up the trade war will likely lead to even worse consequences than the 20% trade war-induced correction that occurred in 2018. And not to mention, valuations are substantially, dramatically so, higher for U.S. equities currently compared to where they were in 2018. So I just think that, you can be sanguine. We can be a little more sanguine because of our economic assessment, but careful with that sanguineness. Trump's talked about external revenue service. Another person on the BCA panel brought that up. He's thinking tariffs are in Trump's DNA, and if they do this, well, then that's going to have to generate revenue. So here's the just kind of the general narrative around that. It would aim to create a government entity responsible for collecting tariffs, part of the broader American First economic agenda. However, from AP News, the proposal has faced criticism regarding legitimacy and practicality. And you can't disagree with the fact that the name External Revenue Service is misleading, because tariffs aren't paid directly by the exporters of those countries. They're paid upon receipt by the importer of the good that's being tariffed, and then they've got to figure out how to get that cost back. And many argue that that's the ultimate consumer of that good is the one who pays for it. Fox Business said that the establishment of the new agency may be redundant, given that the U.S. Customs and Border Protection currently handles the collection of tariffs and duties. So you really wouldn't need to pay for a whole new department in the U.S., it's already taken care of. I think they're pretty efficient in how they collect those tariffs. So I just say it goes back to what I said the other day, and that is that the whole tariff conversation is really a stick in the negotiation process. Okay, so I titled this next little section in my copies and pastes, Less Bad. Europe is very interesting to us, and largely because we have a pretty good position there in their equities. But when I talk about Burberry, I'm talking about the global economy. They followed the surprise earnings results from Richemont last week with much stronger than expected results. Comparable sales from companies' retail stores were expected to fall 13%, but they only fell a modest 4%. So still negative, but hence my title, Less Negative or Less Bad. All regions beat, with APAC down 9% versus a 20% decline estimated. Europe, Middle East, and Africa down 2% versus 4% estimated. The Americas up 4% versus negative 9% estimated. Mainland China only down 7% versus down 19% estimated. Headline revenues from retail selling beat by 11% in this quarter. The company sees a 35% year-over-year drop in wholesale revenue, however. So again, just my point being, and this is what you look for when you're assessing economic conditions, is you're not waiting for everything to look very, very good. You're looking for things to look less bad, and hopefully you'll be early in terms of your expressing the recovery in your portfolio. American Express was another big report last week. In line, Q4 adjusted earnings per share on revenues just a touch above consensus. The adjusted EPS was in line with estimates, while loan loss provisions were down 14%, in another signal that the worst of the tightening cycle's impact on consumer credit performance has passed. Okay, so next year's revenue growth, they're expecting 8% to 10%, just below the longer-term range of 10%. Again, nothing to throw a party over, but less bad, right? Another signal that the worst of the tightening cycle's impact on consumer performance has passed. The preliminary or flash purchasing managers indices from S&P Global, broadly better than expected, as shown above right, and that's this chart. The average PMI release rose from 47.2, still contractionary, 48.6, but less bad. And then down here, Eurozone PMI got back above 50 at 50.2. That's back in expansion from 49.6, which is nearly there, which is better than they estimated, which would be a still contractionary 49.7. Slightly less bad manufacturing print. Germany's manufacturing remains very much under pressure. Its services PMI actually was above 50, which is the dividing line between expansion and contraction at 52.5. So less bad or better news overall, something we need to pay very close attention to see if that's the beginning of a new trend. And then here I was getting into some deeper weeds on the dollar in terms of positioning of emerging markets. There's a theory out there that I don't agree with. This Whitney Baker, who's an exceptional analyst, she made a point here that supports my rejection of that popular theory about where the dollar goes from here. And then lastly, I might as well show you these since I left them up. Every week, I personally go through the futures traders' net positioning on, probably a couple of dozen at least, securities and currencies and so forth, indexes and commodities and you name it. So I wanted to show you the positioning right now on the US dollar, on the yen, and then on the Canadian dollar, and I'll tell you why. So net futures positioning right now is net long by 15,000 contracts, and this is non-commercial futures traders. That's how they classify that group. For asset managers who trade currency futures, exceedingly bullish on the US dollar, while leveraged funds are far less bearish than they've been on the US dollar. So here I'm telling you that if the dollar rolls over, it's very bullish for, let's say, equities, and it would be for our commodities exposures as well. And I'm showing you now where futures traders are either resoundingly bullish or almost bullish on the dollar. right? So at first blush, you'd say, well, maybe I should respect that. Well, actually, the reason I look at these, or the primary reason, is to see when traders are too far out over their skis, right? So what you look for is a scenario where, like I'm saying, the technicals are pointing to a weaker dollar, or conditions might as well if they go a certain way. So folks who are all bulled up on the dollar conceivably could lose a lot of money if it turns. And therefore, they would dump those futures contracts, putting more downward pressure on the dollar and exacerbating the downward move. And so this can be useful in terms of gauging what's next if you have a thesis that goes against what you're seeing there. As for the yen, we are very bullish the yen on a 1 to 2 year horizon. And we've made a little money in our yen position, and we've added to it of late. You can see that non-commercial traders are net bearish. They were way net bearish back in here, and then they got bullish when the yen started to go. And remember, we had quite the pop back in here in the yen last year. And part of it was massive short covering, right? I've talked about that a zillion times. So you had non-commercial traders hugely short the yen. Once it started going up, they had to cover big time, and then they got bullish, and that pushed the yen higher. And you can see it happened here as well, right? Well, we're back to everybody bearish the yen. First one was the non-commercials. Here's the asset managers. And here are the leverage funds, very, very bearish the yen. There's quite a bit of oomph that can come from traders that can push the yen higher. Should also talk about the euro, right? Because I've been talking about European stocks. I mentioned a minute ago that fund managers have been rotating big time into Europe. Well, notice here that non-commercial traders are very short the euro still. So the euro is the biggest counter currency in that dollar index. So if these guys and gals capitulate and cover those shorts, that could push the euro up and at the same time push the dollar further down, which would be bullish for equities. Asset managers are still pretty darn bullish the euro, just not as much as they were, say, last fall. And then leverage funds are exceedingly bearish the euro. Now, who really knows what motivates these positions? It could be big-time hedgers, right? It could be a lot of these who have long euro exposure and they're hedging that a bit, like we do with S&P 500 put options, but they're hedging it by shorting some of it and so on. But nevertheless, we look at these things and we take them for how we see them. And right now, you can see for the euro, at least 2 of the 3 categories we track are pretty darn short. And again, if they cover, then that would be bullish for the euro, bearish for the dollar. And all 3 categories are bearish on the yen. Of course, if they cover, bullish the yen, which is a position of ours, and bearish the dollar, which would help equities, particularly non-U.S. equities and our currency exposure. So folks, I threw a lot there at you today. This process and these videos is really just me sharing with you some of the things that we are seeing as we do our day in and day out, week in and week out, deep analyses on all the things that we think are important to watch as we fulfill our duty to the folks who trust us with their financial futures. Thank you so much, as always, for watching and listening. Hope you have a great rest of your weekend, and I will either talk to you or write to you on the blog next week. Take care. Bye-bye.